Okay, well, welcome everybody to Unilever's Q&A. Have with us Alan Jope and Graeme Pitkethly. And please enter your questions, and we'll get on with doing the full Q&A. We have no questions in yet. Alan, is there, while we're waiting, is there anything you want to say to?
Yeah, I think first question's just come in, Richard.
Oh, there we are. Yeah, it is. So, Alan, you've always said that every 10-point increase in share equates to around 100 basis points on group organic growth. Given we saw that level of share gains in Q4, plus a big 250 million increase in marketing in H2, why shouldn't we see a meaningful pick up, I think I should say?
I think Warren probably means a meaningful pickup in growth.
Yeah.
You know, Warren, there is such chaos going on different geographical mix and different product category mix that this is the rule of thumb that I gave applies in so-called normal times. What we're seeing, as Graeme showed in the presentation, is massive swings by geography and by category. And so that rule goes out the window for such volatile times.
Okay, thanks, Alan. So the next question we have is, you emphasize strategic focus on higher growth spaces, such as functional nutrition and alternative proteins. Competitive advantage versus Nestle that has been in this place for a long time. Going head to head or focusing on specific niche areas. So I think what's our approach to that area?
Yeah. I'll take that one, and then Graeme, whatever comes up next, you can do the next one. So we are very clear on our functional nutrition, the benefit spaces, the geographies, and the formats that we want to compete in. We've chosen them because they're high growth, they're unconsolidated, and we can bring functional differentiation in those segments. So it's not head to head because it's such a fragmented category, and it is certain specific segments where we think we have the right to win. And so far, so good. The business is growing 25 to 30% where we're already competing.
Thanks, Alan. So yeah, Graeme, so with input cost inflation expected to increase, added costs from increased e-commerce and pricing pressure from retailers and private label, can you reiterate how you plan to recover and progress margin, given your continued priority of top line growth?
Yeah, sure. I mean, first of all, let me say that the outlook that we see for commodities and foreign exchange going into the first half, which is really all we've got visibility of right now, is for mid to high single digits. And therefore, we're very active on pricing. There's a number of pricing actions that have gone in across different parts of our business, things like India skin cleansing, Brazil skin cleansing, etc. So that's very much normal business for us. You know, things like e-commerce and retailer pressure and private label are fairly constant. There's no massive degree of change there. And then just to reiterate what we said in the presentation there about margin development, we will start to lap the COVID on costs and the mix impact from the second quarter of 2020. We did step up brand and marketing investment very significantly in the second half, and we were conserving spend in the first half of last year, and therefore, you know, that will be a bit of a headwind in the first half. We'll have a much more even basis of BMI during the course of the year. So yeah, I mean, we'll see the impacts of the on costs and the mix start to be lapped. Pricing is going in the normal way to cover the commodity and foreign exchange combination that we see. And as we said, we expect to grow our profit faster than our top line, which would mean some margin expansion.
Okay, thanks, Graeme. So another plant-based question, Alan. As part of your focus on plant-based food, how much investment are you making directly into R&D for lab-grown or cultured meat?
Yeah, look, we've said that we want to build a €1 billion business in plant-based, but that is not all going to be cultured meat or protein alternatives. That includes, as a first priority, vegetarian and vegan options on our big core brands like Knorr and Hellmann's. So along with our ice cream brands, we're seeing tremendous growth in plant-based offerings within our big core brands. The icing on top is things like the Vegetarian Butcher, where we are making tremendous investments because Vegetarian Butcher consistently wins in blind product testing against other protein alternative product forms. So I want to be clear that plant-based is on our big core portfolio as well as protein alternatives.
Okay, thanks, Alan. You showed Unilever is lagging market growth in North America. What plans do you have in place to narrow the performance gap? And how does M&A factor into this equation?
Who are you directing that to, Richard?
Yeah, so Alan, do you want to pick up that?
Sure. At the beginning of 2020, we were quite far behind on our competitiveness in North America. We were just below 50% of our business gaining share in the US when we in Q4. And without sharing too much, it's very dynamic, our 12-week market share data. We've already seen the data through the end of January, and we're already above 50% winning share now through the 12 weeks ending January for North America. And we don't need to acquire to build competitiveness. We just need to take advantage of the very strong positions we have. Remember, we're number one in deodorants, we're number one in skin cleansing, we're number one equal in hair care, we're number one in dressings, we're number one in tea. So we have a very strong position in North America. We just need to make sure that we're consistently gaining share. And in the latest 12 weeks, it looks like we are.
Okay, thank you. Graeme, a question for you on e-commerce. How much of your business is direct to consumer, and what have you learned about that channel in 2020?
Let me break it down for you. Within our, let me talk about e-commerce generally. First of all, we've got about a 5 billion e-commerce business. And as we said, that grew by over 60% in the full year last year. And it's now 9% of Unilever. That's a little bit less than some other players and our peers in our space, principally as a result of the types of products that we sell. But that's a huge step up. It was 6% last year. This isn't, absolutely D2C, but I just want to make the point that about a third of that is pure play. So that's business that we have with Alibaba, Amazon, etc., and that was growing at over 50%. The really pure play direct to consumer businesses we've got two effectively. First is Dollar Shave Club, which we bought a few years ago. That's about a 240 million business or so. And secondly, our Prestige Beauty business, which is a 700 million business today, amazingly has 50% now of its business taking place in e-commerce. And of that 50%, about 30% of the business is direct to consumer off the branded website. So in totality, we've got 30% of 700 million in Prestige, which is direct to consumer, and Dollar Shave Club. What we've learned about direct to consumer, first of all, during 2020 is how quickly it can grow. I mean, that pivot within the Prestige business is really, really remarkable because they had a lot of door closures. A lot of the specialist beauty stores, Ulta, Sephora, etc., were closed. Moving 50% of that business into e-com has made it, we think, the most competitive Prestige beauty business that there is right now in the world. Declining by 5% the full year, 2% in the fourth quarter is by all the measures we can get of market growth, a really, really good performance. So we're very happy with that. Then with Dollar Shave Club, we learned a couple of things. These are more multi-year. I'll try and summarize them quickly. First of all, direct to consumer works really well in two cases. One is very high value density products, so very high price points, which is what we have with Prestige. That's why that works for that business. And secondly, where you have a very sticky consumer need that you're solving through a subscription model, and that's Dollar Shave Club for you. So they're the two main direct to consumer businesses that we have.
Okay, thanks, Graeme. Alan, a question on brand, which I think is for you. How does Unilever identify a purpose for a brand? Are there some brands that are not inherently purposeful?
So first thing I would say is that purpose on a brand is a powerful way of differentiating and driving consumer preference, but it has to be on top of superior products. So we begin with products that benchmark in blind testing as better than the head-to-head competition, and that's what our R&D guys are preoccupied with delivering. The purpose dimension, really we look for two things. The first is is it a significant concern for a lot of people? So women's empowerment, climate change, inequality, big issues. And the second is, does the brand legitimately have the right to do something about it? So Dove, of course, does take action to help girls with their self-esteem. More recently, Hellmann's has started to fight against food waste, and a very legitimate thing for Hellmann's to do, because you can avoid food waste by using leftovers with Hellmann's. So we look for purposeful brands on top of superior performing products. We look for the intersection of big societal need and brands' right to contribute to that. And the short answer is yes, there will be some brands at the end of the day where it's just, we can't figure out how they make a positive contribution to society or the planet. And most likely they'll leave the portfolio at some point.
Thanks, Alan. So, Graeme, a question on M&A and prestige. Your focus on prestige beauty is interesting, given that it is such a competitive space. Do you plan to make acquisitions to expand your existing set of brands? And how big an acquisition would you make?
Well, the entire prestige business has been built over the course of the last 3 or 4 years through acquisition. The particular strategy we had for it was a string of pearls. We saw the opportunity to buy very attractive founder-led businesses with an organizational model that puts a sort of an infrastructure around that, a very light infrastructure, but there's a sort of a overlying governance to that. And that's what's taken us from a standing start up to about north of 700 million euros today. So quite a significant, very fast growing business. So we are interested in continuing to pursue that same string of pearls strategy. There's an optimum number of brands. We've got 8 brands in the portfolio now. And 2 or 3 more brands are quite able to be operated within the existing infrastructure and organizational model that we've got for it. Our overall ambition, both for functional nutrition and for prestige beauty, is to get both those businesses on a multi-year basis up to about 3 billion euros each. Now that's going to require fast rates of organic growth, which we're seeing today, and also continued M&A. And that's why, as I think was in Alan's part of the presentation, we're so clear that where we want to evolve our portfolio, where we want to put our capital to work. And you can see on a look back basis that we've been very, very consistent, with more than 70% of our M&A capital going in the specific areas that we call out for future attractiveness. So yes, we will continue to acquire in this space. It's very competitive. You have to be very, very disciplined. Asset prices are very high. You're typically dealing with businesses that are quite young in some cases and very fast growing. So you just have to be very diligent, very disciplined in what you're doing. But yes, we will continue to acquire in that space, I think.
Okay, thanks, Graeme. A question on tea, Alan. You have said that the tea division will be functionally independent by the end of this year within Unilever. Is it not possible for tea, the world's favorite drink after water, to be premiumized in a fashion comparable to coffee?
Aha, a seductive argument, and the argument that caused us to take probably 5 years too long to reach the conclusion that we've reached. Tea is basically a very local category, and around the world we compete with often vertically integrated agricultural commodity players who are quite happy to operate at low margins. And as a result, tea has been a top and bottom line drag on Unilever for over a decade. Even the most premium teas are still incredibly low cost per cup compared with premium coffees. And so we've concluded that Unilever is holding our tea business back and tea is holding Unilever back. And so we have made the decision that we'll separate it out by the end of the year. And actually we will take it one step further than that. So we'll look at the maximum value creation option, whether that's IPO, spinning it, partnering, or selling it, but it will sit outside of Unilever by the end of the year or shortly thereafter.
Thanks, Alan. Right, we've got a question on balance sheet and credit rating, so I think that's coming to you, Graeme. As we consider your expectation to manage leverage around 2 times, is there an opportunity to deviate from this for the right strategic opportunities? Also, how important is maintaining a high A credit rating?
Well, I mean, the first thing to say is that the credit rating and the balance sheet leverage that we have is exactly a function of two things. It's optimizing our cost of capital and also retaining the strategic flexibility to make, significant strategic moves should that be something that that makes sense. And it's always been that way. That hasn't changed. That's why we're at strong single A in the first place, because we believe that for our business that optimizes keeping that strategic flexibility and also access to low cost of capital. So that hasn't changed. In terms of the 2x leverage target, Richard, it is a swing around that. If we're a little bit below it, a little bit above it, we don't worry too much. It's a sort of long-term balance point, equilibrium really, that we want to get over the longer term. As we said in the presentation, we've got a high ROIC. We're very cognizant of the numerator and denominator in ROIC. And so in terms of, major strategic moves that would move us off that credit rating and cause us to have to, repair it, we think in a very disciplined way about that. And it would have to be something highly, highly strategic and in the long-term interest of the company.
Okay, thanks, Graeme. Alan, I'm going to ask a question about advertising. We'll come back to it on geography, probably best from you, Graeme. But Alan, has your advertising changed since COVID, and are you confident it will benefit the company?
Thanks very much, Richard. I was looking at the questions, ready to answer the one about the geography over the last 10 years, but not to worry. The job of our marketers is to be absolutely on the front line of consumer sentiment. And of course, consumers have been preoccupied over the last 12 months with COVID. And many of our brands have shifted their messaging. The most obvious example is in hygiene, where Lifebuoy and Cif and Domestos have been making direct claims about COVID. In fact, we were the first company to prove efficacy against the specific COVID virus in a soap. However, there's been other things happening. So for instance, Dove was very quick to address its point of view on racial equity in some work around Black Lives Matter. And our foods business addressed the issue of people doing far more eating at home with recipes and tips for eating at home. And then, frankly, a whole business system innovation called Ice Cream Now. I must admit, when our ice cream team came and said, we're going to do e-commerce ice cream, I thought they'd lost their minds. But it turns out that by tapping into the home delivery trend around COVID, we've been able to build a multi-100 million euro business through ice cream, home delivery with your pizza, or your Chinese meal, or whatever else you're ordering at home. So it's the job of our marketers to be on trend, and therefore they've reflected that in the brand communication over the last year.
Okay, thank you, Alan. So given the next question after this will be about margin, Alan, do you want to answer the geography question since you'd prepared so well over the past 8 years?
Thank you, Richard. Look,
shall I just read out, Alan, just so that everybody can hear? You have been advantaged geographically, yet your sales growth has lagged the overall categories in those geographies. Why?
There's really been two distinct phases over the last 10 years. So up until 2014, the emerging markets were growing very quickly, and we were enjoying the benefit of that, growing 6, 7, 8%. There was a marked slowdown from then on, and our sales weighted category growth has been around 3%, 2.5 to 3%. And the issue has been that we've not been gaining share against that. So we've been stuck for the last 4 years at 3% growth. To Warren's opening question, as markets revert back to the mean, and I think you saw great, our point of view is they will. And as we maintain competitiveness around 60%, then in markets that grow sales weighted 3%, we should do 100 basis points better than that. That's our plan. And then any mixed benefit from portfolio change should come on top of that. So that's more or less the algorithm that we're working to.
Thanks, Alan. So, Graeme, how exactly are you providing comfort to the naysayers on margins vis-a-vis top-line growth? The bears argue for a margin reset. And when do the restructuring programs come to an end?
Okay, well, let me tackle the naysayers on margin reset, etc., because we've been battling this for quite some time. The first thing to say is that Unilever's margin progress has not come at the cost of its growth and competitiveness. Its margin progress has simply not come from there. I want to be really, really clear here. Our margin progress has come from the delivery of savings, which have been funded through the increased rate of restructuring since 2017 that we said we would do. In 2017, we said we would double the rate of restructuring investment in the business. Prior to then, it was about 100 basis points a year. It was about 500 million a year. We stepped it up to about 1 billion a year. We also stepped up our rate of savings delivery then to 2 billion of savings a year. And that's where our margin progress has come from. Our margin now is about 300 basis points higher than it was back in 2016, and therefore is a phenomenal platform for value creation going forward. To the naysayers on margin reset, etc., and I've said this many times over the last couple of years, the areas of our business which have delivered the biggest step up in both competitiveness and growth have been the areas of our business which have delivered the most forward progress on margin. Areas like our home care business, areas like our business in India and our food service business, or our business in China. I could give you many, many examples. So you have to click down a level to see the facts of what we've been doing with margin progress. It's come from diligent investment of restructuring. Now on restructuring, just to round out on this, from 17 to 20, we invested 3.6 billion at that elevated level of restructuring. That delivered savings of 1.5 billion with a payback of 3 years. We're extremely disciplined. We can measure it very, very accurately. That was mostly in the supply chain in Latin America and Europe. It was mostly in R&D, and it was dealing with the unsheddable costs of our spreads divestment. They were the big areas of that. We now see continued opportunity to invest at very good paybacks in restructuring, but only for 2021 and 2022, because by then the job is done. You can't endlessly restructure your supply chain or your R&D function, for example. Where that money will go will be, again, in the supply chain. Got a little bit more work to do in Europe, a little bit more work to do in ice cream. We're restructuring our food solutions business to move to digital selling. And we are fundamentally investing to get to the next generation of global business services in our UniOps platform. So that's investing in process harmonization so that we can liberate resources in the company and drive up productivity at that foundational layer of global business services. So we'll spend another 2 billion in 2021 and 22, 1 billion each. Again, we think that'll deliver 1.3 billion of savings over that period. And the paybacks will be around about 3 years. At that point, we will drop back to our normalized level of restructuring investment of about 100 basis points a year or 500 million a year from 2023 onwards. So I hope that sets it out.
Thanks, Alan. Very, very clear. Alan, on innovation, from all the categories existent today, which ones do you believe will most benefit from innovation in the next 5 years?
It's a slightly dangerous question, that one, because we need outstanding innovation in all of our categories. It's the nature of consumer products. And so we've made the announcement over the last 2 weeks that we're stepping up our investment in R&D on already healthy levels to make sure that we're driving that. I think at a future date, we'll set up some sessions to take you through some of Unilever's proprietary technology in each of the divisions. But to try and answer the question a bit more directly, I think we expect a higher proportion from innovation in beauty and personal care. And as a result, we've got the technology I mentioned in the presentation, our Invictus deodorant technology, unsurpassed. We've got core hygiene technology using silver ions and some natural products in our skin cleansing. In skin care, many technologies like PPARs, HSA12, which give us advantages in skincare. So all of our categories need high levels of innovation to win, but it will be marginally more intense in beauty and personal care, I think. And I think, Richard, we'll take a session to do a proper job on the science coming out of our labs with our investors and analysts.
Right, got it. Yeah. Graeme, on digital, can you flesh out your digital investment and what it will achieve? Should you not invest more short-term for long-term growth?
Oh, we're investing massively in digital, like all companies in the space. We all talk about it a little bit differently. If you want to come at it from the broadest level, which is maybe not the best way to view it, but I'll give you the data anyway. About 40% of our brand and marketing spend is now what you could term digital, but that's far from the full picture. Because as soon as you click down, it's very, very high in China, where the majority of our spend is digital, and it's very low in a market like India, where there's a completely different dynamic. But on average, it's about 40%. But that's far from the full picture, because we've invested enormously in building internal capability around things like our people data centers, which is our social listening and ability to gain and scrub and scrape data and insight digitally. Things like Ice Cream Now came out of the people data centers. Alan mentioned it earlier. We've got 40 of those around the world. We've got our digital hubs, where our marketeers come together to work on digital content and digital insight. We have 30 of those around the world. There isn't a key Unilever market that doesn't have a digital hub. Everybody that came to Englewood Cliffs last year will have spent time in that space. And then there's the fundamentals, which is our media group, and we're just leading capability in terms of how we buy digital media, how we make sure that digital media spend is audited, that it's real humans who are looking at it, and most importantly, that on the social platforms, our content and our brands are showing up in safe places, and that is a really, really key capability for us. So we're investing ahead. We have been investing ahead of the curve for years now, and we're very happy with where our digital capability is. I mean, we again, there's a portfolio difference. It's a little bit like ecom, but Unilever is it's not digital marketing. It's just really marketing in a digital age, and we're very happy about the progress that we continue to make there.
Thanks, Graeme. So Alan, actually another question on ecom. You're at 9% ecom today, which is impressive for your portfolio. Do you think you're beating peers in your categories online? And what is your best guess where e-commerce is as part of the mix 5 years from now?
We're getting short of time, so I'll try and give a very punchy answer. On omni-channel, our market shares online are more or less the same as offline. For business-to-business e-commerce, we're winning. We're ahead of, I think, any of our major competitors. For direct-to-consumer, it varies according to the business model, as Graeme outlined. And on pure play, which is JD, Ali, Amazon, our market shares are below our offline shares. And so it's a big priority for us to step up our shares on pure play. 5 years out, definitely north of 20% of our business will be on e-commerce. And we're very happy about that, because it's got an attractive margin profile for us as well.
Okay, we've only got a little bit less. So I'm just going to jump to a question on ESG, Alan. I think you can do it quickly. How do your ESG efforts and carbon footprints help Unilever financially? Probably in about 30 seconds.
Well, Richard Taylor's going to be pissed off, Richard, that you didn't get his question at the top of the list.
So he'll send it to me. He'll send it to me, Alan.
The business case for sustainable business is becoming sharper and sharper in our minds. First, there is no doubt that brands that take on social and environmental purpose grow faster than the rest of our portfolio and the rest of the market, number one. Number two, it takes out cost. We think we've saved 1.2 billion euros from sustainable sourcing. Number three, it reduces risk for the future. And number four, it's a magnet for young talent. So our employer brand has gone through the roof thanks to our commitment to sustainable business. When you put these four factors together, it shows up in the bottom line. We're convinced that it is part of our secret sauce is our commitment to sustainable business.
Okay, thank you. Thank you. Nicely fitted into the time. Thank you, Alan. Thank you, Graeme, for answering those questions. Thank you, everybody, for asking all the questions, and enjoy the rest of the conference.